Our next presenter is Brennan Turner, CEO of FarmLead. Brennan is the CEO of FarmLead.com, North America's grain marketplace. He holds a degree in economics from Yale University and spent time on Wall Street before starting FarmLead. In 2017, Brennan was named to Fast Company's list of the most creative people in business, and in 2018, a Henry Crown Fellow to at the Aspen Institute. He's originally from Foam Lake, Saskatchewan, where his family started farming over 100 years ago and still turn dirt on 50,000 acres to this day. With that, Brennan.
I think this is okay.
Good to go?
Good to go. I always love wearing one of these mics. I feel like my idol, Garth Brooks. No? Nobody's been to a Garth Brooks concert? Never want to do this? Okay, just me. It's great. Okay. So we're going to talk a little bit today. I think I'm the last, best for last. Isn't that what they say? I'm going to talk a little bit about grain markets, and we're going to talk about a little bit of risk management, how we approach grain markets. Today, kind of a gambling sense versus a proactive risk management process that you would see at a hedge fund level. So, as quickly mentioned, originally from Saskatchewan, family farms between there and North Dakota, quite a bit of land. But I'm a nerd. And I went to Yale, and then I dropped out of Yale. I actually played some pro hockey. If you YouTube my name, you might find a few videos. I'm a big teddy bear off the ice, so. And we've done some great things at FarmLead, the things I'm most proud of on my team, and the fact that we've been named to Forbes' most innovative companies in agriculture the last couple of years. So we're doing some great things, and I encourage you to check out FarmLead. Okay, let's jump into it. A couple main themes within the current ecosystem that is grain markets. First, geopolitical risk is the fundamental driver of pretty much everything that's going on right now. If you are a reader of the FarmLead Breakfast Brief, it's free. We've got about 50,000 readers every week now. We know that supply and demand are set. We know what's going on in terms of how much production there is out of South America, give or take a couple million tons in soybeans, wheat, we know what's going on. But because of some protectionist policies and kind of the rise of populism, if you will, this just drifts prices lower. And so, again, if these import tariffs on peas, durum, well, durum a little bit, you'd say in Italy, kind of a backhanded tariff, or soybeans in the U.S., the point is that these tariffs don't help prices, right? It's pretty clear. We can see it on our bid sheets and the text that we get on a daily basis. And so as a result, with people not wanting to play with each other like they used to, there's a game of musical chairs that's going on, specifically in the grain market. Specifically, you see it most in soybeans, the flow of soybean trade within Canada. How many soybean growers here in the audience? Okay, so I got a number, good number. We'll talk a little bit about it. But at the end of the day, there continues to be a massive growth of protein needs in Asia and Africa. And so that's why I'm relatively long-term bullish on the oilseeds industry, specifically soybeans, canola, among other things. So I'm going to breeze kind of quickly through this, and we'll talk a little bit about each chart, but this is just kind of a picture of what the futures market in Chicago has done for soybeans the last couple of years. In the far right or left of the screen here, you see that we've started out well below where we were the last couple of years. Again, this is the impact of import tariffs on the market, okay? And at the end of the day, the most insignificant thing out of the U.S., again, we don't know for sure because we haven't got USDA export data basically since the middle of December. Most significant line is this Chinese one. I'm going to try to use the pointer here. Don't use it a lot. China, 98% lower year over year, right? We'll try it over here. Oh, too far. No, I can't do it. I've got farmer hands. Point is that you're seeing U.S. soybeans go everywhere else except China, and soybeans from places like Canada, Brazil, Argentina, et cetera, are going to China instead, okay? Musical chairs. Until these tariffs are relaxed or we see better prices, it's likely that you're going to see less acres in 2019 in the U.S., but probably actually more in Canada, mainly because of some decent price levels, especially in Ontario. If you're not exporting beans in Ontario right now, then you're basically not doing the right trade. Because basis is indicating that you should be exporting. Here in Canada, just mentioned it, kind of exports growing pretty strongly year over year, about 20%. Production seems to be pretty stable. Just a quick note on my charts. On the far right, again, we're going to use pointers here. Where is it? Point right. Far right, very, very far right column is the 5-year average, and then I put the last couple months. And so you can see the variation from the reporting agency in terms of how these are changing. In the middle, you'll see 2017, 18. So from a price standpoint, this is specifically to southwestern Ontario, Chatham area, but because of the strong export campaign and the strong domestic demand structure, especially on the feed side of things, you're going to see a pretty tight carryout on soybeans. And again, this is why I think that you're going to see more Canadian soybean acres in 2019 seeded. Even though prices are lower, again, the indication is that we probably should be heading higher in terms of prices. So factors. I like to think of things in a bullish and bearish scenario. What are the things that could potentially push prices higher? What could potentially push things lower? You're going to see this across all the different crops I'm covering. And so, again, I mentioned a very strong Canadian export campaign, and ultimately the aggregate demand structure, all the different things that soybeans are going to be bought for, is only growing and getting bigger both domestically and abroad. It's bullish, right? On the other side, though, the bearish side, the downside risks, as we would call it, more Canadian acres in 2019. There's still this uncertainty of the U.S.-Chinese trade war, what's going to happen. Again, even though they're having some dry issues right now in Brazil, still going to see a pretty big soybean harvest out of those producers. Technically the second largest ever. Last year was a record. This year probably going to be a little bit less. Okay, corn. Again, prices, a little bit better than what they were at this time a year ago. I mentioned it this morning. One analyst has projected that there's an 83% chance that December 2019 corn futures are going to hit $4.25 a bushel. They're sitting kind of around 4.03. I don't know where they close today, but somewhere just over 4. So, you can see a little bit of price expectation, although there's some different things going on that are supporting that factor. Again, we had a huge crop in the U.S., decent-sized crop in Canada, but U.S. corn exports, actual shipments, boats getting loaded out, tracking 76% higher year over year. This is huge. And so even though the USDA is only projecting a number that's about 2.5 or 2.6% higher year over year increase in corn exports, everywhere on this board except for measly Peru, corn exports out of the U.S. are increasing. So again, this is why you're seeing some of this positive price scenarios going on. And at the end of the day, though, this is an indicator. These are buying more acres in 2019. Again, not just here in Canada, and again, specifically Ontario, but also in the U.S. Here at home, had a decent year, about 14.5 million tons produced. Exports tracking a little bit lower. Again, U.S. corn being the cheapest in the world right now. That's where a lot of the competition is coming from. But because of some of the vomitoxin issues in Ontario, we're actually having to import more corn this year to satisfy the domestic demand structure for the Canadian corn market. Very bottom right there, you see imports up a little bit year over year, but actually 43% higher than the 5-year average. So food for thought there. Corn price standpoint, ending stocks looking pretty bullish, I would say. And at the same time, prices are doing pretty good. So I would say that there's a pretty strong appetite here from a bullish standpoint. The domestic demand structure continues to be growing. Ethanol production in Ontario is healthy. And also the ethanol campaign or mandate in China is starting to come online in 2020. The question is whether or not they're actually going to be importing corn. It's a big question. Downside risks, though. I mentioned it quickly. More corn acres likely again in 2019. Probably see a little bit, maybe close to the same as this year, maybe a little bit more. But there is some disease issues denting the bottom line in Ontario. And so maybe we're going to look for a little bit more of a rotation out there. Something to consider. Okay, got 3 more crops. Wheat, barley, canola. Front month prices on Minneapolis, doing a little bit better, about almost 1% better where they were a month ago. Year over year, though, we're tracking a little bit lower, right? Not necessarily great. I'm going to get to some of the cash prices, though, here in Western Canada. On a cash, this is the average spot price across Western Canada. It's actually doing a little bit better year over year, and that's something we should consider. I'm going to dig into a little bit of the Manitoba and Eastern Saskatchewan prices specifically in a second here, but we had, again, a pretty big production year across the world. Far left, the biggest drop you probably saw was in Australia as well as in Russia, going from basically 85 million tons that was produced last year in Russia. There's 70 million tons this year. And then specifically in Australia, produced 21.2 million tons last year. And then you can see fourth from the right, their first estimate was for 21.9 million tons of wheat, and then it was for 19.1 million tons of wheat, and now it's for 17 million tons of wheat. So there's a lot less wheat basically from some of the major competitive export competitors, specifically Russia and Australia this year. And so from an export standpoint, right now the expectation is that Australia is only going to export around 10.5 million metric tons of wheat. This is paltry compared to their, the last couple of years, but especially their 5-year average, right? You can see that 40% lower year over year. And so from a Canadian standpoint, hey, had a pretty decent years. Again, yields kind of surprised us. We never trust the stats, guys. I hope they're not here. But point is, there's still a lot of wheat out there, and we're on track to potentially have a record year of non-durum wheat exports from the Great White North. Technically, you see here back in 2014-15, you had 18.8 million tons in exports. This year, we have a strong possibility of hitting 19 million metric tons, and that's pretty significant. And again, this is due to some of the export factors. Right now, tracking to date 18% higher year over year through week 24 of the current crop year. Pretty strong campaigns. You can see the background there is the blue line is 2017-18 last year, and then the 3-year average behind that in gray. From a price standpoint, relatively decent. All things considered, we're going to have a lower carryout getting close to that 4 million ton number. I think there's a strong possibility that we could dip below it. These next couple of weeks are going to be highly dependent on what happens in Australia, how Asian millers are looking for supply, if they're covered or not, and then also, is there going to be Russian subsidies in terms of being able to make their wheat still competitive. Right now, Russia's basically run out of exportable wheat or is very close to it, and so the government is considering subsidizing the rail freight to get grain from the outermost parts of the country to the port location so that the port price can still be competitive. They're considering it, hasn't been solved or decided upon yet, but it's something to consider, right? So if I look specifically, this is a bit of a busy table, but this is new crop prices. And on the far left, you can see what the cash price is for October-November delivery. In the middle column, you see what this exact same contract a year ago was in terms of both cash price and basis. So look for your specific area, Northeast Sask, Southeast Sask. Sorry for some of our North Dakota farmers. And then the change year over year. From a cash standpoint, it's looking pretty good. Specifically, Eastern Manitoba farmers, your basis is amazing. And this should be something that you should consider looking at seriously because if I just quickly scroll back to the futures price, where we go. Look where we're at in terms of how far we are below what was expected, right? We can get potentially some of those higher values, and from a spot price, we're getting close to the highs that we saw late May, early June last year, but it's something that you should consider thinking about locking in here in the next couple of weeks, I think, because there's a pretty strong indicator that, specifically in eastern Manitoba part, and maybe even the cash side for everyone else, you should be looking at some of that new crop pricing opportunity. This is why there's still a lot of wheat in the world. And further to this, if I think about some of the bullish things, yes, there's some question marks about high quality wheat. In places like Australia, obviously Russia, they don't produce a lot of it. We're going to have a tight carryout. And we have really strong exports, right? That's really great. That's really positive. But we still have a huge carryout. But there's probably, I don't know of any country that's basically not planting more wheat in 2019. That's a bearish indicator, right? And there's still some crop left over from last year that's blending off, and again, that's impacting the final say in terms of where prices are. So, net, think about managing some of this risk. I think you guys are getting where I'm coming at. Bearish risk, bullish catalyst, etc. Okay? Okay, 2 more crops, and we'll get into some of the meat potatoes. Barley production still pretty good. Here across this is specifically in Australia. Again, drought situation, 7.3 million tons of production. Now, this is down significantly, and why this is important specifically for some of our barley growers in the room, if there are any. Any barley growers? Okay, not too many. You're the unlucky ones, I guess, here. or we're the lucky ones if you get a specific audience. Point is that exports are very strong. China's importing a lot, although Australia probably won't be able to export as much. They have a very, very strong domestic demand structure in Eastern Australia right now that is literally putting prices. You can basically land U.S. corn in Eastern Australia at almost $100 a ton, U.S. dollars a ton, less than what domestic feed barley prices are in Australia, in Eastern Australia right now. So the point is that the incentive is to, if you're growing barley in Western Australia, just to ship it to the other side of the country, even though it's probably got to go on a boat, because you're going to get paid more than going into some of those international markets. And so, specifically, we think of China. We know that there's a lot more Canadian barley going there. And usually, Australia exports somewhere around 4.5 to 5 million tons of their barley to China alone every single year. But right now, there's a dumping probe on Australian barley by them, or by the Chinese. And also, again, you have the smaller crop. So who has to make up for this? It has to be somebody else, right? And Canada's probably in the best position to do that after an 8.5 million metric ton crop this past year. Currently, the Agriculture Canada group is expecting about 2.45 million tons in exports, which would be slightly lower than last year's record set of 2.82 million tons. The problem, though, is that we're tracking 33% better than what we were doing at this time a year ago. Should we not have higher export expectations? My guess is yet. This time a year ago, I said that we were going to hit a record number. It was time-stamped in the Western Producer, and at that time, they were, again, calling for about 2.4. I think this year we could probably get close to that 3 million ton number on barley. And so, domestically here, some pretty strong prices, but I'm just cognizant of some of the downside risks that we saw a couple years ago, and just got to be cautious of that, basically, okay? Needless to say, ending stocks across the world still very tight, and that is what I would, again, call a bullish indicator in terms of what can help the price go higher. Strong Chinese demand, relatively speaking, have a little bit of a smaller European malt barley crop, and this is attributed to the drier growing conditions there, unfortunately. But it's creating more export opportunity for Canadian barley. On the bearish side, there's lots of feed cereals available in North America right now. Corn, again, still very, very cheap relative to barley in the world market. And also Russian wheat and barley is getting cheaper, and they're planting more of it in 2019. Okay, last crop, canola. Prices are tracking a little bit lower than last year, but relatively decent, actually. And all things considered, we think that there should be a little bit more demand structure in specifically the Chinese market, but again, geopolitical risk is kind of getting in the way. I'm not going to play politics here, pick a side, but it's certainly impacting our tradability. And so if I think about our production year and our export year, again, the Agriculture Canada guys and girls are thinking that we're going to export a record crop of 11 million tons. Keep in mind that their last estimate in November was for actually 11.5 million metric tons. And so they've downgraded their forecast of what we're going to be able to export. Domestic use is going to be the same at 9.5 million, 9.55, and the carryout jumping a little bit year over year to 2.5 million metric tons. From an export standpoint, we are tracking a little bit lower year over year. Not by much, but it's enough to cause a little bit of concern at 8.5% behind last year's pace. Again, I attribute some of this to the geopolitical situation that's going on, but at the end of the day, I think that from a cash standpoint, again, we're not too far behind where we were a year ago, and considering all these kind of negative, bearish scenarios that are kind of pushing on the canola market, this is an indicator that things are structurally pretty good. And if we didn't have some of these geopolitical risk situations going on, that would probably be a little bit higher. And so, with this in mind, let's look at some of the new crop prices again. October delivery first column, where that, and November delivery first column. This time a year ago, what were prices doing? And so from a cash and basis standpoint, basis is actually a little bit worse and cash is a little bit worse. And so the question is, should we maybe just wait for some of those futures before we start, or maybe go futures first, price of the futures today, sitting in close to that $500 number, as you can see at the very bottom of the screen here, right? A year ago, the November 2018 new crop contract was sitting at today, January 22nd. Well, today's the 23rd, but I put these charts together yesterday, so sorry. it's not far behind, basically, right? And so all things considered, I think it's something that to consider for your new crop. Canada, by far and away, best producer of canola/rapeseed in the game. We're also obviously the best exporter. Nobody can play ball with us when it comes to growing and shipping the crop out. So from a bullish or bearish standpoint, again, these factors that I think about and how this can affect what we're producing, China is looking for basically anything that's not soybeans. This has been, we could say there's a little bit of an asterisk here because of some of the tension between Beijing and Ottawa. And so as a result, the question is, hey, record exports is a very bullish scenario that I get excited about, but I'm not seeing it today. And so I'm starting to maybe think about, is this export number becoming a little bit more of a neutral situation? Again, smaller Australian crop. Australia is probably going to import somewhere between 250 to maybe 500,000 tons of Canadian canola this year. Basically a market that we never ship any canola to. So again, that's a slightly positive thing. On the bear side, though, do we see more canola acres in 2019? Pulses aren't necessarily paying. Durham's definitely not paying. What do we grow? Pencils suggest that maybe we should just put more canola in. So it's kind of a bearish. So I haven't seen too many estimates yet. I think it's going to be somewhere similar to where we were last year, but maybe a little bit higher. And again, we still have a pretty big carryout, unfortunately. And then again, exports rather sluggish. So this all comes out, like how do I think about some of these different risk paradigms and all the different situations affecting the different crops that I grow? How can I manage some of these scenarios? If I think about it in kind of a more macro, big picture scenario, what's going on? And I can tell you that really a hedge fund, I come from a world of Wall Street, but again, my roots are on the farm, and really hedge fund managers are just like farmers. They have to weigh multiple different variables, and they have to deal with multiple different suppliers and vendors and people within their operation. And there's many outside factors that they cannot control. They are not in charge of whether or not a CEO bribes another company to do a deal, right? They cannot control that. Maybe they're part of their bribe, I don't know. But the point is, like Mother Nature, we cannot control. These are factors we cannot control. The difference, though, between hedge funds and farmers, though, is that they understand this risk, they respect it, and they ultimately by acknowledging and managing it, or accepting it and respecting it, they're managing that risk better. Okay? So I'm going to go through a mathematical example here. It's very straightforward, pretty, it's some kind of straightforward numbers. We could play a lot of what-if scenarios, but, and I'm happy to debate with you guys after, down here or up there. I don't know if someone's talking after me, but the point is that I want to walk through a scenario of how a risk manager would approach their crop production versus maybe a gambler, and you might see some echoes of yourself on either side of the equation today. So let's say that I can grow 1,000 acres of canola, 450 an acre, maybe a little bit high for you. I usually account, when I'm producing a cost of production spreadsheet, I account for paying myself a little bit on that spreadsheet, okay? So $450 an acre, yielding an average of about 45 bushel an acre, maybe a little bit better in some of this great soil here in Manitoba, but we're saying it's about 45,000 bushels, okay? It's the exact same thing as buying $10 shares, 45,000 of them from a company. You're producing an asset, right? And so as a result, your total purchase price, whether you're acquiring those shares or acquiring that production of canola, it's $450,000, okay? Everyone got the mental math? I see some notebooks. Just kidding, no one's using a notebook. If we go into the growing season, you're always going to see a little bit of price premium, right? There's a little bit of a bump maybe in the share price. For us, it's a weather premium situation where it's always going to help support the price go a little bit higher, right? So we're seeing $12 a bushel. Even though I haven't got it in the bin yet, I'm a proactive risk manager. I know that this is usually a seasonal trend, and the price tends to drop back down. And so I'm going to manage some of my exposure. I'm going to forward contract some of this. I'm going to sell 20%, going to sell about 20% or about 9,000 bushels and get a nice little return, guaranteed. Okay, this is important for the next phase. Whereas the gambler says, I don't sell anything until it's in the bin. If the likelihood that you're not going to be able to contract or produce, if you're not going to be able to produce at least 20% of what you're expected to grow, then even in the scenario that there's insurance and whatnot, and you have a total crop failure, there's usually somebody else that's going to probably buy out that contract, or this is a proactive risk management process. And so thinking about what are the likelihoods that you're going to wipe out 80% of your crop versus the likelihood that the price of that crop is going to go down, the latter is more statistically significant and it's more likely to happen. And so you have to weigh some of your risks like a risk manager would, a hedge fund manager would, if you will. Okay? So we get to the harvest season. And instead of contracting on the harvest lows, I'm actually fulfilling that contract that I made earlier in the growing season at the highs, right? And whereas the gambler has to think about, shoot, well, I usually use another word. There might be some fellow Mennonites in here, so I gotta be careful. But usually, I need some cash flow, and I gotta put something on paper here. I gotta deliver on a couple bushels, and I don't want to sell at this price, but I need some cash, right? I gotta put something, move some grain. And so my ROI on that first sale is 5% instead of the 20% that the risk manager had, okay? I am a big advocate against selling at harvest time. There is rarely a time that you're going to see the best price of the crop marketing year at harvest. There's like a handful of situations I can count in literally the last decade where that's happened. Winter markets, we're getting into kind of the November, December time frame, okay? Price jumps back up from those seasonal lows, and there's some good currency factors and demand factors that's supporting the structure. I'm selling into that strength. I'm going to manage some of that risk. We saw $12 before. I think that the gambler says, I think it's going back to that $12 or maybe even higher. And so I'm going to wait. I'm hoping for a better price. One of the first things I learned on Wall Street is that hope is not a risk management process. You have to factor in all these different factors. We're not selling 100% or 90% or 80% at this price. We're selling a specific incremental lot of about 10 to 30%. In this scenario specifically, it's 30%, okay? We get back into the nearing spring, where we're anticipating kind of around now, we're anticipating another relatively decent crop. Maybe there's some geopolitical risk on the table, right? And prices start to pull back. And there's some bearish acreage estimates. And so from a risk management standpoint, I know that, hey, based on how Canadian producers have been performing in the last couple of years, regardless of the conditions, they're still bringing out a harvest that's ridiculous. And so I'm managing some of this downside risk by selling a little bit. No one likes to sell necessarily on the downside, but I think that given some of these bearish risks and some maybe of these slower exports and maybe some of these bearish geopolitical risk environments, I'm thinking that there is more downside risk. And so I'm going to sell a little bit. Whereas the gambler thinks, I need some cash for inputs. I got to make a sale. It didn't hit that $12 that I was really hoping for, or that $13 that I thought it could be going to, and Coffee Row was telling me it was going to happen. And so I need to, just kind of take it on the chin and sell some grain so that I can get some cash in for some inputs and get ready for the next growing season, okay? As we get into the following growing season, there's still a little bit of stuff left in the bin. As the producer that's thinking about managing some of that risk, it's a big crop again. You know what? I need some bin space, and I'm going to sell my remaining 20%, spreading that out. On the flip side, that other producer who's gambling and hoping a little bit more says, you know what? I need a bin space. I think price could go higher. I don't like it right now, but I got to sell before this thing goes down further. And so he sells out. Game summary, basically. Risk manager versus the gambler, as I'll call it. When I spread out my risk and I manage some of the different bullish catalysts versus the downside risks and the bearish factors, and I spread that risk out over a couple different sales versus just one or two, and instead of like hoping that the price is going to get back to where it was at the highs, I'm selling incrementally, okay? There's a simple mathematical equation, or not equation, but example of how significant this can be. 25K in a growing season. Again, this is accounting for some of paying yourself a little bit, but the point is $25,000 is a lot of money when you're in pretty tight margins in a lot of other crops, okay? And so some of the takeaways that I encourage you to take pictures, whatnot, to take this home with you, get your phones out. The first is just admit we don't know exactly what the market's going to do. Accept that fact. Okay? The best risk managers and hedge fund managers that I know do this. They run billions of dollars, and they just know, I can only control so much. I'm going to manage my downside exposure or my exposure to the downside risk scenarios. And so this is the second point. Acknowledge this and be careful of there's more downside risk to the market. I got to be careful of how much I have left in the bin. If you have 80% of last year's harvest left in the bin, you are 80% exposed to the market. If you multiply that by today's cash price, that's how many dollars of exposure to the market that you have today, right? And if it goes down another 20 cents, take that off and put that new price in. What's the difference between those two values? Is it 10 grand? Is it 20 grand? That's your downside risk, very concretely, okay? The third factor is weigh these different upside opportunities versus the downside risks, okay? This is a little bit tougher one to do. I encourage you to lean on people, maybe your marketing advisors. Again, I write the FarmLead breakfast brief a couple times a week. Happy to answer questions. Throw it out into Twitter, put it onto the Combine forum, whatever it is. Ask questions. Don't be afraid to try to understand what's really happening, because the last thing you should be doing is not asking the question and then kicking yourself later for not asking it, right? Be proactive. Be a risk manager. And so as the market potentially reaches new heights, risk managers sell into that strength. They don't sell all at once, so they don't say, hey, it's going to go higher, and I'm going to wait till it goes higher before selling anything. Maybe it's a truckload. Maybe it's 2 truckloads. Selling into that strength is something that you should seriously consider. And if there are downside risks, reduce your exposure to that market, okay? The last one, just because you don't need to sell doesn't mean you should stop managing your risk. This explicitly means if you have a nice padded bank account, doesn't mean you should forget about the bin that you have in the yard full of grain, okay? We have a pretty big operation within our family, and I can tell you, pulses in Durham from 13 to 16 were pretty good years. We made a lot of money, but we also lost a lot of money, and mainly because my uncles specifically and the family members just stopped managing risk. We have a lot of money in the bank account. We don't need to worry about it as much right now. I can tell you, if I asked that exact same question to one of my hedge fund buddies in New York, they would say, I never stop managing risk, regardless if it's $1 million deal or a $100 million transaction that I'm focusing on. I don't care how much of my position is in the market. I'm always managing risk. And so there's kind of 5 steps that I also think that your grain marketing should live by. Get your grain tested. It's a simple cost. I know that you use some of the elevators around you. That's very important, but I also am a firm believer in independent testing. It doesn't cost you much at the end of the day, a couple cents per acre basically when it comes to your cost of production. Second thing is listen and read about the markets. Again, shameless plug for the FarmLead breakfast. There's a lot of different things out there that you can read, a lot of market advisories. Now is the time, go around to a couple of the different booths, get some trials signed up for. Just be aware of some of the different things that are going on. And when you're talking about actually contracting, discuss things like storage fees, if they apply, some of the costs in the U.S. it will, premium discounts, scheduled discounts, what are the opportunities versus delivering today, tomorrow, 2 weeks from now, 2 months from now, et cetera, et cetera. Have those conversations, they're important. And then I think it's very important to break these sales up into 10 to 30% blocks. Don't think about it as selling, hey, it's a good price, we should sell, the neighbors are selling. Just break it up, break up that risk and spread it out, because you're more likely to get into a situation where we have some regret, or, man, I wish I would have sold more, but at the same time, I'm going to explain in a second, but if I know that there's a better opportunity, I still have some left over to sell. This is really, again, another shameless plug. Explore all your options, making sure that you're talking to all the different grain buyers. FarmLead Marketplace, we have nearly 1,000 different credit verified companies on the system today. We're seeing about $10 million worth of cash grain trade on a daily basis, so it's pretty significant through the system. Just explore those options. And so my last ask of you is be a grain marketing risk manager in this next coming crop year. I implore you to try to minimize the loss aversion that you're going to deal with. This is the feeling of when the market goes lower and I did nothing, versus if the market went higher and I sold a little bit, but I still have some left over, right? How many of us in this room have said, shit, I should have sold something? Everyone. Don't be a coward, come on. It's a fact, right? It's this loss aversion of, man, I wish I would have done something and I didn't. And again, if the price goes higher, The point is, I still have some stuff left over to sell, right? I'm not selling it all at once, but try to minimize that loss aversion. Manage your risk and avoid loss aversion, okay? And then do some pencil farming and calibrate kind of every quarter. I really ask you guys to give yourself permission to sit down with your significant other, family member, with the accountant, whoever it may be, and do some pencil farming. I would strongly avoid alcoholic beverages while doing this. Probably have a good pot of coffee, but pencil it out. Go through some different scenarios. If you're already working with an advisor, an accountant, go through some of the different scenarios so that you know when 1150 comes up at the local crush plant or whatnot, hey, that's an opportunity we've been looking at basically since middle of January when that Garth Brooks looking guy, Brennan Turner, came and talked to me. Right? Garth Brooks? No? Okay. But I think this is very important that you should just put it down on paper. I'll tell you why. The visual aid of having that consistently on paper and looking at it is very important. When I was in grade 12, I was at a school called the Alphamore College of Notre Dame. At the beginning of the year, I put on a little Post-it note in my locker, playing for the Notre Dame Hounds Junior A team. I had two goals. One, I wanted to get an NCAA Division I scholarship, and two, I wanted to get drafted in the NHL. Those are my two goals. And every day I woke up and I had to look at it. It was this constant reminder. Wasn't on Central Scouting, anything like that. Never got any pretty looks. I've got still the baby face. People notice that. The point, though, is that it was a constant reminder. I constantly worked towards it, and I constantly looked at it. And I had the blessed opportunity to go to Yale University. I ended up getting a degree in economics from there. I was drafted in the 5th round, 134th overall by the Chicago Blackhawks. Got close to playing in the NHL, a couple of training camps, nothing necessarily concretely, but just getting to that point. It was having that constant reminder to try to achieve better, to progress and do better. It's very important. So I implore you to try to be a risk manager and set some goals for yourself this crop year. That's it. Any questions? Oh, we had a question over here. Something about oats?
What do you think about using options?
Options. Got it. Oh, is this on? Okay. So options, one, I strongly recommend working with a professional on that. Two, really set your expectations of comfort. So this specifically means don't be speculating. This is the one concrete ask. But I think that hedging and using the futures markets appropriately is probably one of the strongest risk management tools out there. The problem is that they're extremely confusing for a lot of people. And so again, I really defer to working with a professional, and I can tell you that probably the cost of using that professional is worth it. So also though, worth pencil farming in terms of what those different strategies look like. Again, defer to the expert. If you're not the expert, find one. Use them. Leverage them, become an expert through that expert, and it'll pay dividends significantly down the road. So yes, I'm a believer in hedging, but I can tell you that it's not for everyone. You have to really put your mind to it and just be patient and work with an expert. Good question, though. Important question. Other questions? If not, I mean, I'm pretty noticeable. I'm not a small guy. Or you can just, send me an email, shoot me a text, hit me up on Twitter. I'm not on Instagram, sorry. Don't do it, even though my sisters want me to. But really appreciate it. Thanks for your time today. Thanks for Manitoba Wheat and Barley having me. And drive home safe. Cheers.
Thank you very much, Brennan.